I have seen this movie before, not the exact headlines, not the exact politicians, not the exact war map or the exact television graphics or the exact experts pretending certainty from behind polished desks. I mean the deeper movie, the one where the financial system starts breaking in a place most people do not watch. The crowd misreads the first signal. The people in charge tell you they still have options, and then asset prices begin moving in a very particular order because the system has already chosen its response before it admits it out loud. That movie does not begin with stocks. It does not begin with real estate. It does not begin with Bitcoin. It begins with gold. And that is why what just happened matters so much. Something happened in the market that has only happened a handful of times across decades. Gold was supposed to rally on war. Every talking head knew the script. Safe haven panic bid, flight to security. That is what everybody expected. Instead, gold was slammed. It dropped hard, fast, and violently enough that the crowd took the move as evidence that the old safe haven logic had broken. That is exactly the kind of misunderstanding that makes big fortunes for patient people and expensive lessons for everyone else. When gold collapses during a major global stress event, the average investor sees contradiction, the prepared investor sees liquidation. That difference is everything. A lot of people do not understand what gold does in a crisis because they think gold's job is to go up the instant fear appears. That is not always its first job. Sometimes its first job is to tell you who is desperate. When everyone needs dollars immediately, they sell what they can sell, not what they want to sell. That means even the strongest forms of collateral, even the most sacred. So-called safe havens can get hit first because they are liquid and useful and can be turned into immediate funding. Gold gets sold not because it failed, but because it worked too well as something that could be sold. That is step one. And if you do not understand step one, you will spend the rest of the sequence reacting to smoke after the fire is already in your own house. I want to make this very plain. The drop in gold is not the story. The drop is the flare. The story is what it means. It means the math under the financial system has moved from uncomfortable to unstable. It means the people who run the machine are losing degrees of freedom. It means a decision is coming that they will pretend is temporary, technical, necessary, reluctant, and responsible. In reality, it will be the same decision they always make when the arithmetic gets impossible. They will print, they may not call it printing, they may dress it up in emergency, lending, liquidity support, market stabilization, repo facilities, balance sheet tools, backstop programs, reserve operations, or some other nice sounding bureaucratic perfume, but it will be printing. And once you understand that, the whole sequence opens up in front of you. Most people think crises are random. They are not random. They are chaotic on the surface and highly patterned underneath. The surface gives you headlines. The pattern gives you money. Now let me walk you through the pattern. The pattern starts with stress in gold because gold is the oldest lie detector in finance. It tells you when trust is fraying before politicians admit trust is fraying. It tells you when monetary debasement is near before the newspapers start using the right words. It tells you when the people closest to the pipes know the pipes are about to run hot. And what just happened in gold matters because this kind of drawdown during a major global shock has not happened often. That is not some charming little trivia point. That means the current setup belongs to a very small historical family. And when you are in a rare family of setups, the past becomes more useful, not less. People love saying this time is different because saying it makes them feel sophisticated. They get to sound above history, as if every other investor was naïve and only now. In this special moment do we finally have a crisis worthy of genuine fear. I have heard that phrase around recessions, wars, banking failures, commodity spikes, housing collapses, and monetary experiments. Nearly every time the phrase becomes fashionable, somebody somewhere is about to pay too much for present fear and too little for future recovery. So let us not do that. Let's be cold. Let's ask the question investors should always ask in a rare setup. What happened last time? Not just what was said, what moved in what order. Why? Because asset classes do not reprice in a panic the way television explains them. They do not all move together in one beautiful synchronized moral lesson. They move in waves because liquidity moves in waves and policy responses move in waves and human understanding moves in waves. That is why the order matters. If you only know the event, you are already late. If you know the order, you can get in front of the event's consequences. The order begins with gold and commodities. That is wave one. Gold gets hit first in the liquidation. Then it bottoms. Then it starts to recover before most people are emotionally ready to trust it again. That is not a contradiction. That is a tell. The first flush is forced selling. The bounce is smarter money repositioning for what the next phase requires. Why? Because once the system starts to understand what is coming, capital moves toward things that cannot be printed. That phrase matters: cannot be printed. Gold cannot be printed. Copper cannot be printed. Oil cannot be printed. Agricultural land cannot be printed. Good energy reserves cannot be printed. A world entering monetary stress slowly begins bidding for real scarcity. That is what Wave 1 is about. It is not about the television narrative. It is about the first migration away from faith-based paper into things with physical limits. But gold is only the messenger. The real engine underneath the current setup is oil. You can insult me for talking about oil if you want, but the machine does not care about your preferences. Energy is upstream of almost everything else. If the world suddenly loses access to a meaningful portion of oil moving through a single choke point, the consequences do not remain inside a barrel. They spread through diesel, transport, freight, fertilizer, food, manufacturing jet fuel, industrial input costs, and finally into the prices ordinary people pay without ever understanding the geopolitical map that caused it. That is how real inflation moves, not as a headline first, as a pipeline. And what matters now is not simply that oil prices are high. What matters is that the world is structurally short. Some barrels can be rerouted, some reserves can be tapped, some temporary measures can soften the visible wound, but if the net shortfall is still large enough, then the system is not solving the problem. It is leasing time. There is a gigantic difference between solving the problem and leasing time. Most governments survive by leasing time. That is what emergency reserves are for. That is what special releases are for. That is what policy theater is for. But here is the problem with lease time. Eventually the lease ends, and when it ends, the old pressure comes back with less buffer and more attention. That is exactly where the current setup becomes dangerous. In the last major energy shock, policymakers still had a cheat code. They could open emergency reserves, flood the market temporarily, and buy just enough breathing room for the public to calm down and for the numbers to soften at the margin. They did it. It worked well enough to reduce acute pain. It did not solve the structural issue. But in politics, enough temporary relief can pass for a solution if the cameras move on. The difference now is that the cheat code has been heavily consumed. You do not get to keep pulling rabbits out of the same hat after the hat is empty. That changes the entire arithmetic, because now a prolonged oil shock does not meet a flexible state. It meets a government already spending more on fixed obligations than it collects in taxes. That is the part almost nobody wants to look at, because it is boring and fatal at the same time. Boring numbers scare people less than dramatic stories. They should scare them more. What matters here is not just debt in the abstract. Americans have been trained to hear trillion-dollar debt numbers the way city people hear ambulance sirens constantly, background noise. No urgency. The more important number is what I would call true untouchable expense. The spending the government really cannot cut without detonating its own political structure. Interest on the debt, Social Security, Medicare, entitlement obligations, fixed promises, the kind of bills that cannot be waved away with a press conference. When those obligations rise beyond tax revenue, the system has crossed an invisible border. At that point, everything else is borrowed, defense is borrowed, infrastructure is borrowed, education is borrowed, political theater is borrowed. The state is not managing a budget, it is carrying a civilization on a credit card while pretending the line of credit itself is the plan. That is the moment where people in charge start losing optionality, and that is what gold is trying to tell you. Because once recession risk rises on top of that, tax revenue weakens right when obligations strengthen. That is the nightmare. You do not get lower income and lower costs together. You get lower income and higher mandatory expense together. That is what corners the central bank and the Treasury. Not ideology, math corners them. Math always corners them in the end. And when they are cornered, there are only a few doors. Door one is to allow cleansing pain. Let the economy break. Let markets fall hard, let weak hands die, let unemployment rise, let insolvency express itself fully. In theory, that is the cleansing answer. In practice, it is politically radioactive. Politicians do not survive that choice. Central bankers do not get praise for choosing that level of visible pain when they still have a printing press. Door two is the one they keep choosing: print, devalue, stabilize, backstop, flood support. Again, they will call it something else because the public tolerates euphemism far better than honesty. But the effect is the same: more dollars, more balance sheet, more liquidity, more quiet theft from savers and fixed income holders. More fuel under any asset that cannot be copied by policy decree. Door 3 is a hybrid of pain and printing, which is really just Door 2 arriving, after a short performance of Door 1. That is usually how the play is staged. They posture, they talk tough, they act as if discipline still exists. Then markets force their hand and the printers begin. That is why I say the decision is made before it is admitted. The math has already selected the answer. Once you understand that, the four-wave sequence becomes easier to see. Wave 1 is gold and commodities. Wave 2 is the dollar. This is where people get confused because the dollar can strengthen first. In a panic, the world scrambles for dollars because oil is priced in dollars. Debts are owed in dollars, liquidity is needed in dollars, so demand for dollars rises even while the system underneath the dollar becomes more fragile. That seems contradictory only if you confuse immediate need with long-term trust. The world can desperately need dollars today and trust them less tomorrow. Those are perfectly compatible realities. In fact, they often occur together. Temporary dollar strength during acute panic is frequently the setup for later dollar weakness after policy responds. The emergency bid for dollars comes from scarcity. The later fall comes from deliberate oversupply. First, the world scrambles for the currency. Then the authorities create more of the currency to stop the scramble from becoming a collapse. That is Wave 2. And when the dollar finally weakens, it does not merely change foreign exchange charts. It accelerates everything that began in Wave 1. Commodity prices rise harder in dollar terms. Inflation that was already moving through energy chains gets reinforced by a weaker unit of account. The public starts feeling the problem more widely, not less. Then comes Wave 3. This is where hard assets reprice: real estate, land, commodity producers, infrastructure, things with physical utility and finite supply. This is the part of the sequence where a lot of people suddenly think the asset itself has become magical. It has not. The unit used to price the asset has become weaker, and the market is compensating for that in the least surprising way possible. Houses do not become more sacred. Scarce productive things simply hold their footing better than paper promises when paper promises are being multiplied. In inflationary repricing cycles, real estate can look like genius, even when the real genius was simply not being all in on currency. People misunderstand this constantly. They talk about property appreciation as if the building itself spontaneously discovered ambition. Much of the move is currency decay, revealing itself through nominal prices. The same is true for producers of real things. If you own the people extracting, moving, refining, or controlling scarce resources, while the money measuring those resources is being diluted, you have a built-in asymmetry. Their revenues can rise with nominal prices while debt often remains fixed in yesterday's dollars. That is a beautiful setup. If you got there before the crowd starts chanting the obvious, then comes Wave 4. This is the liquidity wave that reaches out on the risk curve and eventually hits broad equities and the hardest monetary assets. By the time this wave arrives, the first-order panic has been metabolized. Policy has turned more openly supportive. The dollar is no longer the temporary hero. Liquidity is flowing harder. Investors start hunting not just for protection but for leverage to the debasement itself. This is where broad risk assets can reawaken. This is where the market machine starts turning crisis policy into future nominal upside. And this is also where Bitcoin enters the conversation. Whether traditional people enjoy that sentence or not, you do not have to love Bitcoin to understand why it matters in this sequence. It is a fixed supply asset inside the digital financial system. It cannot be printed into existence because a Treasury official got nervous. It sits at the far end of the scarcity spectrum in a world where liquid scarcity becomes more valuable. Every time confidence in managed money declines, that does not make it safe. It does not make it linear. It does not make it morally superior. It makes it relevant, especially once policy has moved beyond panic defense and into full liquidity release. People often laugh at Bitcoin until they realize the joke they thought they were making is actually about fiat. I am not telling you to go all in on anything. That would be stupid. I am telling you to understand the order, because the people who build wealth in these sequences are almost never the ones making one giant bet on one giant narrative. They are the ones who understand where the sequence begins, where it tends to move next, and how to build a structure that catches more than one wave. That is a very different mindset. Most portfolios are built for a soft, polite world, a little growth, a little bond income, stable currency, mild inflation, predictable diversification. The last 15 years trained an entire generation to think in that frame because that frame worked well enough often enough to become invisible. But if the world is shifting into a different regime, then a portfolio built for the old one is not neutral. It is wrong. That is the real risk. Now, not a single crash, not one dramatic day. Being positioned for a world that already stopped existing, while your statements still tell you bedtime stories about diversification. Cash gets hollowed out when the currency weakens. Long-duration bonds can get mauled when inflation is sticky and policy credibility thins out. Growth stories with no real asset backing become more fragile when discount rates and capital costs no longer live in fantasy land. And people holding old regime portfolios will not initially understand why they feel more discomfort than expected. They will think they are unlucky. They are not unlucky. They are mispositioned. So if you know the sequence, what do? You build exposures across the order. Not carelessly, not equally, intentionally. Wave 1 wants gold and real commodities or businesses close to them. Wave 2 wants awareness of currency risk. Wave 3 wants hard assets and productive real-world scarcity. Wave 4 wants the things that absorb excess liquidity hardest when the debasement moves fully through the system. This does not mean owning all of it blindly tomorrow. It means asking whether your current structure owns any of it at all. Do you own anything that benefits from the first wave? Anything that benefits from a weaker dollar? Anything with real scarcity and income as inflation runs hotter? Anything that can catch the late liquidity wave rather than merely surviving it? Most people do not. And that is why they will be late. Not because the information was unavailable, because the default portfolio is designed to make them feel ordinary, not to make them ready. Ordinary portfolios perform beautifully when the regime is ordinary. When the regime changes, ordinary becomes an expensive identity. Now, let me be careful. Patterns are not promises. History does not repeat with exact symmetry and clean calendar dates. It rhymes under different costumes. The lags change. The speed changes. The political packaging changes. The path can be messier than your chart, but the fact that it is not perfect does not make it useless. It makes it more realistic. The 2008 sequence was not the 1970s sequence in pace or shape. The 2020 sequence was not the same either. But the transmission logic remained familiar stress, forced response. Liquidity, repricing, rotation. People who understood the logic did not need a crystal ball. They needed enough conviction to stay rational before the sequence became obvious. That is where most of the money gets made. Not at the end when the headlines finally catch up. At the stage where smart people are still being called alarmists by optimists and too calm by the panicked. And that is exactly where I think we are now. Wave 1 is already fired, gold got smashed, then stabilized, then started climbing. That is not random, that is not decorative, that is the first alarm going off. The only question now is whether you hear it as noise or as instruction. Most people will hear noise. They will wait for the official confirmation, which always arrives after the first big move, then they will chase. That is what they always do. They will buy gold after the rebound is obvious. They will start talking about commodity exposure after the first violent repricing is old news. They will discover real assets after the cheap part is gone. They will become intrigued by Bitcoin after liquidity has already made the later buyers rich again. And then they will tell themselves they were prudent to wait for clarity. They were expensive. Clarity is almost always expensive. That is why I prefer prepared uncertainty to purchase certainty. Prepared uncertainty lets you build before the obvious purchase certainty forces you to pay up after the crowd has done the repricing for you. If you want to build wealth in a sequence like this, your job is not to become a prophet. Your job is to stop being a tourist inside your own portfolio. Know what you own. Know which regime it belongs to. Know what it protects against. Know what it dies from. Know what wave it benefits from. Know what wave it suffers in. That is how adults allocate capital. Not by memorizing slogans about diversification and hoping the old playbook still gets full credit in a new world. The old playbook may not be dead, but it is not enough. And not enough is dangerous when the sequence has already begun. So let me give it to you in one sentence. Gold just fired a rare signal. Oil has broken the arithmetic. The government's fixed obligations have already eaten the budget, and the only politically survivable response left is more money. Once that happens, everything reprices not all at once, in order. And if you know the order, you do not need perfect foresight. You only need to stop acting surprised. That is where the opportunity is, not in one magical asset, not in one macho call. In understanding the transmission mechanism early enough that you can stand where the next wave is going rather than where the last wave has already been. That is how real money gets made quietly. Before the explanation becomes popular, before the headlines simplify it, before the average investor realizes the old environment is gone. By then, the repricing is already happening, and the people who were waiting for certainty are once again financing the gains of people who only needed pattern recognition and a little backbone.